Hello everyone. Welcome to Lineup Stocks. I'm Will. Today is March 8th. This week's price action can be described as extremely weak. The most important data point of the week, the US February non-farm payrolls, came out and painted a really confusing picture. We can sum it up as weak total numbers, but a divided structure. The data showed that February non-farm jobs unexpectedly dropped by 92,000, which is way below market expectations of an increase, and the unemployment rate went back up to 4.4%. The market is reading this as a signal that the labor market might be entering its winter. This is a sharp contrast to the strong start we had at the beginning of the year now. Because of the US and Israeli military strikes on Iran, risk aversion sentiment has gone up a lot. Brent crude oil hit a high of $94 today. JP Morgan urgently updated its review and gave a clear warning. If the strait stays blocked, Gulf countries will stop production much faster than expected. There is no 25-day buffer anymore. The crisis is entering a countdown. Even more shocking, some analysts point out that major oil-producing countries could see their production halts double in just 3 days. This exponential worsening means the world's energy inventory will burn out very fast. Qatar's energy minister painted the scariest picture. If the war goes on, all Gulf energy exporters might be forced to declare force majeure, and oil prices could shoot up to $150 a barrel. The blood of the global economy is getting thick and expensive, and inflation might come roaring back. VIX also hit a high of 29 today. All signs show that the risk aversion mood is very heavy right now. However, looking at the current situation, it's hard for the geopolitical conflict to end in the short term, so market uncertainty is increasing. Let's go back to the sector trends. XLU utilities and energy are very strong, going up against the broader market. Other sectors, whether it's semiconductors, tech, telecom, banks, or industrial machinery, are all going down. This really highlights the halo or safe haven trade. Looking at the index trends right now, even though the QQQ is still consolidating in a box, the Dow has clearly broken down. The Dow's chart has obviously broken its trend. Even though it closed with a candlestick that has a long lower shadow today, the trading volume is clearly not enough, so this candlestick doesn't have much reference value. Based on the current trend, it still needs to drop more to find support. Now let's look at IWM. It reached $250 today, hitting exactly on the support line. The price action at this level is very critical. Right now, from the IWM's chart, it is forming an M-top pattern. When it finishes its measured drop, there will likely be a pullback bounce. If it bounces to the neckline, quickly gets back into the box, and pulls to the top of the box again, then this is likely a golden pit, a great buying opportunity. But there is a very big probability it will break below the neckline, have a small bounce, and then turn its head and go down again. If it walks this path, there is a lot of room to fall on the downside. So the indexes are not just at the edge of the cliff. You could say half of their body is already hanging off the cliff. We must treat this with caution. Let's look at the QQQ again. On the daily chart, it is still consolidating in this box area, and it has reached the bottom edge of the box. In my last few videos, I emphasized over and over that the index has come to the edge of the cliff. From the weekly chart, even though it hasn't broken below the box, it is at the bottom edge. I told you before that I am quite pessimistic about its future trend. You can pay attention to my comments at the end and the weather index. It's not that I see a full bear market, but I am quite pessimistic. Then let's look at SPX. It is still in a box trend, but if it goes back to the bottom of the box, there is still a 3%, 4% drop. So the overall market trend is not very good. How should we operate at a time like this? I have been telling you recently, when trading stocks right now, you must switch from high-level stocks to low-level stocks. What kind of stocks can we enter when they hit the bottom? Candlesticks can lie, moving averages are lagging, but what never lies? That is trading volume. Let's look at the charts of a few stocks. Look at the stocks sitting high up in the sky, like GLW, light and SanDisk. They are all at a high level. From the perspective of volume, look at GLW. Recently, it has obviously increased in volume. Where is this volume? It's at the top. If not the absolute top, it at least shows high volume at a high price level. High volume at a high level means the big money is shipping out. High volume at a low level means big money is collecting shares. So whether it's GLW or Light is also having high volume lately. There is definitely big money leaving here. So I've been telling everyone to avoid these high-flying stocks. Now look at SanDisk. It is also showing high volume here, but it hasn't broken down. Since it hasn't broken down, we have to look at it as a box consolidation. We see it is at a high level. When can we enter? We have to wait for it to break out of the box before we enter. Looking back at its past trend, if the future didn't happen yet and we were right here from when it started going up, this was also a high level. So when could we enter? We look forward. In this high-level box consolidation, I just wait, because I don't know if it will go up or down at this high level. We just don't know. We have to wait for the market to show us its attitude. Since it can break out later, we enter when it breaks out. Let's look at another stock, Costco. Today's candlestick is a very big green candle, right? But there is no volume. So from Costco's trend, I personally think this level is not for us to enter, but to escape. So whether you enter or escape, today's candlestick set a benchmark. If it goes up, everyone is happy. But if it breaks below this candlestick, there will be a relatively big correction later. Also, look at IGV, which I talked about before. It dropped from 117 to 76. Is there volume here? Yes. So candlesticks can lie, moving averages lag, and indicators have a lot of noise. But what doesn't lie, volume doesn't lie. High volume at a high price is big money selling. High volume at a low price is big money buying. Finally, a quick summary. The US dollar is getting stronger because of its ultimate safe haven status, so US stocks are under pressure. Lastly, please pay attention to the risk of Gulf capital retreating. The crisis is quickly destroying the economic foundation of the Gulf oil countries. On one hand, oil production and exports are blocked, and income has dropped sharply. On the other hand, defense and security spending is surging, and tourism is paralyzed. Saudi Arabia, the UAE, and Qatar have started joint talks and are reviewing their trillions of dollars in investment commitments to the US. These sovereign wealth funds are massive. Any shrinking or withdrawal of funds from them will directly hit the financial markets. This forms a negative feedback loop from geopolitical risk to dropping energy income, capital going home, and finally to the market losing blood. Also, CTA will stop buying around March 15th. We have a huge liquidity crisis on our hands. Based on the current trend, the overall market is relatively weak. Just like I said, we have arrived at the edge of the cliff. When we trade right now, we should hold our ground and not move. You must get out of those high-level stocks. If you want to build positions, only lay out positions in stocks with huge volume at the bottom. Alright, this is Line Up Stocks. I wish everyone smooth trading. See you in the next video.